All right, welcome everybody. This is Axel, and I thought I'll do some live comments on the Powell press conference that just completed to give my take on what's been happening. And to just provide some context, the reason we got into these rate cuts in the first place was that about a year ago, the market was before the end, at the end of September, the market was pricing in higher rates, and then the market had a fit. Late in the year, the Federal Reserve started to take notice of that, and then early in this year, the Fed started to signal they might do a turnaround, or at least to pause. And then what really got the Fed to cut rates was the escalation of the trade war. And at the time, I had been one of the voices critical, saying, well, what good is this? What's the point of these rate cuts? And specifically, is it possible to fix the sort of trade issues we have with an interest rate cut? Because I've been arguing that you can't fix a trade war with interest rate cuts. And indeed, throughout this episode, even when the bond market might have had a fit in between or some issues that were in the equity markets, the so-called financial conditions were good. And financial conditions, people define them so a little differently. Some people look at the VIX index, the measure of volatility in equities, and say, hey, yeah, volatility is going up in the equity market, and therefore financial conditions are bad. Well, that's not really financial conditions. Financial conditions is the access to credit. If you think about the role of a Federal Reserve, it's about providing access. It's the so-called transmission mechanism. And that transmission mechanism was really never broken. And in any case, the rate cuts didn't fix the trade issues. But hey, Powell said he's worried about trade, and if they were to escalate, he might do more. And sure enough, the day after a meeting earlier this year, there was another tweet by the president. And then we'd argued, well, we think this president, like any president, would like to get reelected, and trade tensions are likely to abate. And sure enough, we've had the best deal ever, which hasn't been a deal yet. We have had an announcement of a phase 1 deal to be signed in 2 weeks, and the meeting now has been cancelled, but probably for reasons out of control of the trade negotiations. In Chile, there are some riots on the streets, and it's probably not secure enough to host a meeting there right now. But in any case, the trade tensions are easing, and with that, we have now a Fed president who says that we don't need to cut anymore. We've taken out the insurance cut, and this can of course go in many different ways. I'm a bit cynical, simply because if you listen to Powell today, you could have made any decision and justified it. It's really you're presenting the data in a way that you want to present them. He mentioned that business investment is down, and that's really the most concerning thing we have. And obviously the reason business investments are down is because of trade uncertainty. If you think about economic growth, key parameters there are the consumer, which is reasonably stable unless there's an external shock that's huge. Inventories are a quite volatile environment where you can have people hoard goods because tariffs are coming in and so forth. But the one thing that has been concerning is business investments, and those have continued to come down. You've had this global slowdown happening, and of course the fear has been it's going to spill over to the U.S. economy. Indeed, the Purchasing Manager Index in the U.S. had been weak. We have another measure coming out later this week here. We see some green shoots if you want to see the glass half full. In China, some numbers have come a little better than expected. France maybe as well. But there's plenty of reason for pessimism as well. So you pretty much can read this whichever way you want. Now, obviously, you've cut 75 basis points at the Fed now, and it could well be that this is enough. And the question is, well, the Fed may not have the benefit of hindsight. And the thing is, though, if you don't want to be political, maybe it is okay to be reactionary. It is okay to be late. Now, the counter-argument, and that seems to be the one that Powell is more in favor of, is the one that folks like Bullard at the Fed say, listen, expectations of inflation have come down. We've got to do something. It's important that these inflation expectations remain anchored. But again, if you look at why those inflation expectations had come down, it is not because of interest rates, it's because of trade tensions. If you think about the 10-year bond, 10-year notes, it moves with the potential growth of an economy. And so when long-term yields are low, it's a statement by the market saying, hey, our long-term we don't really have much reason to do long-term investments. I mean, long-term rates being negative in parts of the world suggests that our government is a mess, or our government, putting yourself in the European shoes or some other shoes here. And unfortunately, I sympathize with that interpretation more. Monetary policy, again, cannot fix many of these things. You've got to have a more supportive investment environment. You've got to ease bureaucracy to allow people to invest. And to give you an example of what that means in practice, there are, I call them bright kids, they're bright minds in any sort of environment, any sort of world, but the question is how to deploy their resources. Well, today's bright minds put their money into things with instant gratification. Social media apps, some cryptocurrencies and the like, and this is not investment advice for any particular thing, but people put their energy, their brain power in things that give you more instant gratification rather than into long-term infrastructure projects, things that take many years. And the reason is because there's uncertainty about the long term. And so it's the role of the fiscal side to provide that sort of certainty. One of the many things that we had Lagarde come out, the incoming chair of the ECB, scolding specifically Germany and the Netherlands, and officially she doesn't have a title yet, it's still a few days, but scolding them for not spending enough money. Well, the fiscal side isn't just about spending money. It is about the entire regulatory framework. It is about providing opportunities to invest. Tax reform could be one of those. Let me make a few other comments here. The job market. The job market is very strong. Powell pointed out that more people in the prime working years are joining the job market, and I fully agree. The question is how many people can you pull from the sidelines? And nobody has the answer, but there's a risk that at some point you're going to run out of people to pull in. Powell has been praising the wage gains, and it's good for productivity, and that's all great. But what happens if you can't pull any more people from the sidelines? I haven't heard any question today, for example, about the hundreds of thousands that will be hired to conduct the census. Where are you going to take these people from? Now, maybe there are some people that like to get that quicker job, but when you are at near record low unemployment, could it be that you're causing inflationary pressures to move higher? Wage growth is near 3%. It has kind of flattened at that level, but does it mean there is no concern whatsoever? And maybe there's not, but think about it. We have a 75 basis point rate cut. We have a consumer that's strong. We have low unemployment. We're hiring people for the census. And by the way, we have an election coming next year, so there's an incentive to have shovel-ready projects, and there is an incentive also to ease trade tensions. Now, obviously, the trade negotiations have been moving slowly, and at least what we have seen so far, I don't think instills huge confidence for new business investments. But I'm just talking about the risks here, and the risk here is, I think, that we may well get a hot economy running into the election. And of course, the kind of the more mainstream view is that we'll have a recession potentially, although today Powell said, no, that's not going to happen. And so this economy can go in many different ways. What I'm cautioning about, though, is to say, hey, listen, there is nothing to worry about, and we don't have to worry about inflation. And this is also in the context of the Fed having his review. Powell said we're going to institutionalize the periodic review of what we do about monetary policy. Well, the review they have is they're studying whether inflation, having been below target for 10 years, not each and every reading, but most of them, is a problem. Well, when you discuss something very intensely for a long time, you will talk yourself into that it is a problem. And it is a problem that they think it is a problem because the environment we've had for the last 10 years is not the same we are in now. We were in a deflationary bust. We had massive money printing, and we should have had a depression. Because of all the policies put in place. We didn't have a depression, but we had lackluster growth for many years. We kept zombie institutions alive. We continue to keep institutions alive that wouldn't be around if we had higher rates. And so translating that to an environment we have now where we have near record low unemployment, wage growth at 3%, to me is very dangerous. This smells to me of this time is different approach, and because we in recent years had a certain policy, we got to do something different. Quick comment here on the repo market. The Federal Reserve has a communication problem. They haven't been able to keep the short-term Fed funds rate where it should be. After the financial crisis, they switched from targeting the short-term interest rates by intervening with so-called repos, short-term monetary transactions, by paying interest on reserves. And they thought, hey, this solves everything. Turns out it's more complicated than that. And it's not that easy. So they, in addition to paying interest on reserves, they're now intervening in the treasury market. They realize they don't have enough treasuries to do that. And so they announce they're going to buy more treasuries. And they say it's just technical, and it is just technical. But then they say they're going to do it over many months, buying 20 billion of treasuries a month, which to me is baffling. If you do something like 20 billion a month, that smells like QE. And we're told it's not QE. And I agree even that it is not QE. But why on earth aren't they buying 100 billion, 200 billion, or 300 billion within a few days, or weeks at least? And if they were to do that, they would signal that this is very different from QE. I mean, it's just one of the reasons why I'm thinking that they continue to have a communication issue. And then just one final word maybe. So the Fed now has taken away this word that they'll act as appropriate. Not that they want to act inappropriately now, but he's made it pretty clear that the barrier to change is higher now. It's still not clear, though, what it is that they're looking for. It still appears that they're very dependent on the markets. If the market were to have a fit, then the yield curve would flatten. And indeed, the yield curve is flatter. Well, it was flatter. Now it's coming. Yeah, it's flatter now than it was this morning. And so something meaningful, something significant to change would induce a cut. Well, is a tweet by the president going to be significant? And I'm intently being semi-cynical here. I think everybody agrees, whether they agree or not agree with the president, is that he tends to like high drama, right? And so if something dramatic happens, well, the Fed may well change. And so the Fed is still in this thing where they want to be more quote-unquote data dependent, but I think they could be well served to be even clearer. Anyway, it doesn't really matter what I think. It matters what the Fed does. They have the bazooka. And my role here is not to predict what will happen, but to get you thinking out of the box. And thanks for listening to this. I commented recently on the ECB. If you're looking on your favorite channel on for a replay of that. And then if you go to our website at Merk Investments, we have a webinar coming up in November. Not on this topic. I'm not going to promote that too much now. But anyways, thanks for listening, and give me some feedback whether you like this sort of format, because then I might just do more of those. So, and sure, I will also give you here some disclosure. And with that, and talk to you soon. Bye.